Hello everyone, I hope you guys are doing well and studies going in full swing. In today's video, we would be discussing international financial management from your CA final AFM. This is, I would say, a medium level importance in terms of a chapter. It does not really come up in every attempt, but if it does come up, it kind of sometimes become a little tricky to kind of solve. So there are a few concepts over here. We will try to cover those concepts, at least from a practical perspective, theory being aside, and we will also do the important questions from this chapter. Okay, so let us get started. So this is a chapter which has some base of capital budgeting and some base of foreign exchange. So preferably once you have done both of these and you do international financial management, it will be a little more easier. So when we look at capital budgeting, and if I have to select a project, I say typically the best decision making happens at NPV level, that is PVCI minus PVCO. If NPV is positive, you accept the project. If it is negative, you reject the project. So when we look at the evaluation for a project which is outside India or outside your home geography, the evaluation still should remain ideally the same. That is, if the NPV is positive, you accept. If it is negative, you reject. So what are the additional complications or challenges that can possibly come in an international capital budgeting scenario? First, you will have estimated cash flows in a foreign currency. You are an Indian company, let us say. So what do we need to do? We either need to convert these cash flows into the home currency. But at what rate will you convert? Well, we typically convert it at the forward rate, because if there's a project which you are receiving $100 in the first year, $200 in the third year, $400 in the fourth year, and so on, these are cash flows received at a future date. You will convert them at the rate prevailing at that date, and hence these will be converted at the forward rates. However, if forward rates are not given in the question, you can use international parity theories like interest or inflation rate parity theory and derive the exchange rate. So this is where the foreign exchange angle comes in. Now the cash flows are in rupees. These rupee cash flows will be discounted your local rupee discount rate to find the NPV. If the NPV is positive, you accept. If it is negative, you will reject. So this is called as a home currency approach in evaluation of international projects, where you convert the cash flows into your local currency and then discount it at the local currency discount rate to find the present value in rupees. Another alternative way, so this is home currency approach. Another alternative way would be, we don't really convert these cash flows into the home currency at forward rates, which means a foreign currency cash flow like a dollar cash flow continues to remain as dollar cash flow only. We will do sums on this so that you get complete clarity. But now the problem is, if I'm getting a cash flow in dollars, my required rate of return cannot be the same as the cash flow in rupees. A classic example of this is if I were to invest in a US bond. I will again repeat, if I were to invest in a US bond, I will be happy getting 2 or 3% return on my dollar cash flows. However, if I were to invest money where the cash flow is coming in rupees, like an Indian currency bond, I will not be happy at 2 or 3%. I will require a higher rate of return. What applies to, let us say, a bond investment also applies to a capital budgeting project, and hence you will expect a different return in a foreign currency cash flow, for which you will have to infer or derive a foreign currency discount rate. Now this might get a little challenging. So in this case, the foreign currency approach says that you will discount the foreign currency cash flows at the foreign currency discount rate so that the NPV comes in foreign currency. Now how to derive the foreign currency discount rate, we will see. But so that the NPV comes in the foreign currency. Once the NPV is in the foreign currency, you will convert it at the particular rate, because you want to make your decision looking at a rupee number. Now NPV is a net present value, which means if instead of getting $100, $200, $300 over the years, if someone were to give me that money today, how much would that be? That is a present value. But if someone were to hypothetically give me that money today, that means that that is nothing but dollar cash flow in today's terms, which means you will convert it at the spot rate. So the easy approach over here is, you don't need to predict the forward rates. You can keep the dollar cash flows as it is, discounted at the foreign currency rate, that is the required rate of return for a dollar cash flow if available. If not, then we will see how to find the NPV. That NPV is converted at the spot rate, which you can easily find from the market sources. So this is a foreign currency approach. Which approach to be done depends on the data given in the question. Now the problem is, how will you find a foreign currency discount rate? Like for example, you have been given that your required rate of return, let us say in India, is 15%. This is your cost of capital. This is required rate of return on Indian investment. Now, that is your KE. You will say, from an Indian investment perspective, I will at least want to recover on 1 rupee that I invest. I would want to recover the risk-free rate. So that is RF. So that is into 1 plus RF of India. But am I investing in a risky project or a risk-free project? Well, I'm investing in a risky project, and hence I will also want to recover some RP, risk premium. The higher the risk, higher is the risk premium, lower the risk, lower is the risk premium. So over here, I would say, well, this is 15%, that is 0.15. Let's say that interest rate in India is 10%. So into 1.1 plus 1 plus RP in India. So if I go to see, this is, let us say, my rate of return, let's say this is 1 plus KE. So 1 plus your required rate of return equals, that is 1 plus 0.15. Therefore, this is 1 plus 0.15. So the 1 at the start of year should become 1.15 at the end. So this is 1.15 equals 1.1 into 1 plus RP. And as a result, if I were to solve, 1.15 divided by 1.1 comes to around 1.045. If I take 1 on the other side, your risk premium is around 4.54 or 55% approximately. A project, if it is risky in India, unless otherwise given, it is also risky in the US. And as a result, risk premium across the world is assumed to remain the same unless otherwise given. Like a mining business is risky whether the mine is dug up in India or in the US. Whereas a coaching business, for example, is relatively less risky. It's service oriented, whether it is done in India or let us say the US. And as a result, when I look at 4.55%, that is a risk premium, and this risk premium is assumed to be the same whether in India or in the US. So now if I go to see in the US, if the risk-free rate is, for example, only 3%. So if I want to find the required rate of return in US, I would say that even for a US project, I will at least expect 3%, that is the risk-free rate in the US, plus the risk premium, which is the same across the world unless otherwise given, which is 4.55%. So this is 1.03 into 1.0455, and hence if I multiply, this comes to, let us say, 1.0787, let us say, that is 7.87% would be the rate if I were to look at a corresponding project in the US. And this will be my discount rate to discount the foreign currency cash flows so that I can find the NPV in dollars, which I converted at the spot rate. So this is regarding the foreign currency approach. So over here, when we look at the foreign currency approach, 3 steps. First, calculate the risk premium from the home currency cash flows. Second, assume that the risk premium remains the same unless the question tells you otherwise. And then substitute that same risk premium along with the risk-free rate of the foreign currency to find the cost of equity in the foreign currency. Now, this is one of the most common type of questions that the institute comes up with. We will do, I think, question 4 of our important question set, as well as we will discuss a particular thing about inflation and then do question 1 as well. So when you look at inflation in capital budgeting, what happens is usually there are 2 types of cash flows. One is called as real cash flow, which is without the effect of inflation, and one is nominal or monetary cash flow, which is after the effect of inflation. So if you have real cash flows given in the question, you can discount it at the real rate. That is, even the discount rate should not consider inflation. Real cash flows do not consider inflation. They should be discounted at the real rate, which should also not consider inflation. Or you have nominal cash flows, or you can convert the real cash flows into nominal by adding inflation. That is, the nominal cash flows will be discounted, let us say, at the nominal required rate of return. So if the nominal cash flows are discounted at the nominal required rate of return, you will get NPV, which is a consistent NPV. So either real cash flows, that is without inflation, with a discount rate also which is without inflation, or nominal cash flows discounted at the nominal rate. Now, if nothing is given, we typically prefer taking the nominal cash flows and discounting at the nominal rate, but again, you will have to look at the data given in the question for the same. So over here, nominal cash flows after inflation should be discounted at the nominal rate, or real cash flows can be discounted at the real rate in general. Now, there is some inconsistency in the capital budgeting chapter, but otherwise in the IFM chapter, it is fairly certain. In general, if nothing is given and you are only given that the cost of capital is 15%, for example, then you can assume that that is the Indian currency nominal cost of capital. That is, if you have just told cost of capital is 15%, well, if nothing is given in IFM, what institute has always done, and rightly so, is they consider that generally you quote cost of capital of your own country, so it is home currency. Again, in the market, when you go to a bank, when the rates are quoted, interest rates, etc., they consider the effect of inflation. No one quotes the real rates unless otherwise given. So if you go to a bank and SBI says that I'm going to give you 8% return, or I'm going to charge 9% on the loan, that is all inclusive, including the effect of inflation as well, and hence in general, unless otherwise given, you can safely assume, at least for the IFM chapter, and hopefully even institute comes up with consistency in the capital budgeting chapter, that the rates are home currency discount rates, and that consider the effect of inflation as well. Okay, considering this, we will try question number 4 first from the Super 90 question set, which is an easy question, and then go to question 1, which is a slightly more interesting question. So let us quickly try to do this. Now, X Limited is an Indian company considering a proposal to make an investment of around 1.65 crores in US dollars in Latin America. The project will have a life of 5 years, and the current spot rate of exchange is rupees 72 per the dollar. The investments and revenues will occur in USD, and the USD and INR risk-free rates are 8% and 12% respectively. Now, these are the risk-free rates, mind you. Following cash flows are expected from the project. So you have the cash flows given. Let us say if I do everything in full, I think lakhs, just to keep it simple. So this is 30 lakhs, 45, 60, 75, just for easy workings, okay? Okay. Assume the required rate of return in the project is 14%. Now the question remains silent. It does not tell you whether it is the Indian currency rate or the foreign currency rate unless given otherwise. We will assume it is the Indian currency rate. You are required to calculate the viability of the project using foreign currency approach. Question very clearly tells you that you have to use the foreign currency approach. Now within the foreign currency approach, what will you have to do? We will say that your required rate of return is 14. So 1 plus 0.14. In India, you will at least need to recover the Indian currency interest rate, that is 12%. At the same time, you will also need to recover the risk premium in India. So that is 1.14 equals 1.12 into 1 plus RP in India. Therefore, 1.14 divided by 1.12, which comes to 1.07, 1.01, 79 equals 1 plus RP. Therefore, RP equals, if you take this on the other side, 0.0179, that is 1.79% approximately. Now, this is the risk premium which will be assumed to be the same across the world. So, you will say for the US, 1 plus the required rate of return in the US, let's say KE, equals 1 plus 0.08, which is the risk-free rate in the US, into 1 plus 0.0179, and hence if I multiply 1.08 with 1.0179 comes to approximately 1.09933. That is, your foreign currency discounted is approximately 9.93% approximately. Now this is the crux. If you are able to kind of crack this, you are by and large sorted. So over here this is 9.9 or 9.93 to be more accurate. Once you do that, you will say that okay, these are the cash flows. You discount it at 9.9%. Mathematically, this is just pure solving. This is, they have done this in kind of million. We were thinking to do it in lakhs. And hence, if you discount it, this will come to around 18.02. Now, 18.02 less the investment of 16.5 will give you an NPV of 1.52. If the NPV is positive, you will accept the project. However, if you want to convert this NPV into your own currency, you will convert it at the spot rate, that is rupees 72 per dollar. 1.52 into 72 comes to rupees 109.44 million. So over here, as you can see, this is the answer. Further, second part says, what would be the impact if there's a withholding tax of 10% applicable on the project? Now, if there's a withholding tax of 10%, which means I will have to invest the entire 165 lakhs. But when I get, let us say 30, again I will have to have withholding 37.5 I will have to have withholding, 45 I will have to have withholding, and so on. I will have withholding everywhere. And as a result, if I have to have withholding, ultimately whatever is my PVCI, if I go to see my PVCI is around 18.02. From this 18.02 I can also subtract 10% directly, or I can subtract it from the individual cash flows. My answer will remain the same. 18.02 minus 10% comes to 16.22. So this will come to 16.22 million. Comes to 16.22 million less the initial investment of 16.5. NPV becomes negative, again multiplied by 72. The project is not viable and hence should not be accepted. So this is pertaining to question 4. It is an easy question, but it gives you a good understanding of the foreign currency approach. Next question is question 1. I would rate this as important. It is a good question considering inflation, considering home currency approach. All of this is done quite well over here. So let us review question number 1. XY Limited is engaged in a large retail business in India. It is contemplating for expansion into a country of Africa by acquiring a group of stores having the same line of operation as that of India. The exchange rate for the currency of the proposed African country is extremely volatile. The rate of inflation present is 40% a year. Now that's a very high inflation rate. Inflation in India is currently 10%. Okay. The management of XY expects these rates to continue in the foreseeable future. Estimated projected cash flows, fair. See what is given in the bracket for the combined operating project. Okay, in real terms, I would put this as important, which means are these cash flows before inflation or after inflation? Sir, they are before inflation because they are real cash flows. But is there an inflation? Yes, 40% in Africa, 10% in India. In India as well as African country for the first 3 years are as follows. So over here, you have been given the real cash flows. So they can either be discounted at the real rate or you can convert them into nominal cash flows and then discount it at the nominal rate. XY assumes year 3 nominal cash flows will continue to be earned each year indefinitely. Okay. It evaluates all investments using a nominal cash flow and nominal discounted. The question here gives you an instruction, like the last question gave you an instruction that you are going to use the foreign currency approach. Here they tell you have to use the nominal cash flows and a nominal discounted. So first of all, these have to be cash flows. What? After or before inflation? Yes, after inflation. The present rate is given to you as African Rand 6 to the rupee. You are required to calculate the NPV of the investment considering the African Rand cash flows are converted into rupees and discounted at a risk adjusted rate, which means this is the home currency approach. This language says that you have to solve using the home currency approach. Why? Because the question says, yes, nominal cash flows, but nominal cash flows can be in any currency. Well, nominal cash flows, you have to take it in your home currency and then find. So that is, you are using the home currency approach. All cash flows will be discounted at the rate of 20% to reflect the high risk. Okay, assuming that this 20% is the Indian currency discount rate and a nominal discount rate consistently done in the IFM chapter. Ignore taxation. In any case, we would have ignored if the rate is not there and a discount rate at 20% is given. Now, as instructed, we have to take, these are Indian cash flows, these are African cash flows. So over here you are at year 0, so there is no inflation, but then Indian cash flows has a 10% inflation, 1.1, then another 10%, 1.1 into equal to, so this has to be multiplied by 1.21 into 1.1, this is into 1.331. So if I multiply this, I will get the cash flows in Indian currency after adjusting inflation. African Rand, there is a 40% inflation into 1.4, then 1.4 into equal to, this is 1.96 into 1.4, 2.744. This is 2.744. And as a result, if you do this basic maths, you will get cash flows in Indian rupees which are after inflation, cash flows in African Rands which are also after inflation. So over here, you will look at the cash flows. If you want, we can try to do this, but I think it should be manageable. Now these cash flows are in the respective currency. Now I need to convert the African Rand into the Indian currency. So how will I do that? Well, I will have to apply IRP. The rate is given to you as African Rand to the rupee. So in the numerator, there's an African Rand. So F upon S equals 1 plus I. The rate of inflation is given. In the numerator, you have the African Rand. The rate is African Rand to the rupee. So in the numerator, you will take the African Rand and in the denominator you will take the Indian rate. And as a result, for year 1, if I have to find, the answer is, let us say, 6 African rand to the rupees, and hence if I do this working, the forward rate would be 6 into 1.4 divided by 1.1. So this is approximately, you can take more decimals, but for simplicity I'm taking 7.63. Technically you should try to do at least up to 4 decimals. This is forward rate for the first year. You do the similar working for the second year. So 7.63 into, let us say, 1.4 upon 1.1. Second year comes to 9.71. Again, this logically makes sense because African rand has a higher rate, Indian currency has a lower rate. So the Indian currency should strengthen. For every rupee, you will get more of rand. And by the way, you are getting more of rand. 9.71 into 1.4 upon 1.1 comes to around 12.36 approximately. So once we are able to find this, like you can see, these are the inflation factors as we have done earlier, and these are the inflation factors in South Africa or Africa, whatever Africa. These are the exchange rates. They have taken 4 decimals. We have just taken 2 decimals for simplicity, but technically you should take 4 decimals. Now, how will you find the cash flows? You will first convert the cash flows into, let us say, nominal cash flows. These are in rupees. So you will multiply 1.1, 1.21, 1.33 approximately. Now these are rupees. I don't need to convert this. They're already in rupees. African cash flows, we will first make it inflation adjusted. So these are 2 lakhs, then 1.4, 1.96 and 90,000 just for 2.744. This is 246,960. So over here, this will give you the African rand cash flows, but these are in African rand. I need to convert it to rupees. So African rand, let us say over here, should be cancelled. So if I go to see, the workings over here would be, let us say, African rand 6 per rupee into the African rand. So if I multiply it, this will be African rand squared, and hence I will have to take inverse 1 upon African rand. So this is at the start of the year, and hence I will divide each of these cash flows into, let us say, initially you have to spend 2 lakhs. So 2 lakhs divided by 2 lakhs divided by 6. Can I say this is 33.33? Okay. Next, so this is divided by 6. This is divided by 7.36, divided by 9.71, divided by around 12.36, and you will get these cash flows in the Indian currency. So finally, you have the cash flows over here. If I highlight in rupees, over here again if I highlight in rupees, if I add both of them, that will give me the total cash flows on the project, and you will discount this at the rate of 20%, which is given, and that will give you, let us say, the NPV. So the NPV over here will give you the answer in rupees. Do I need to again convert this back? No, the answer is no, you do not again need to convert it back. This will remain, let us say, in rupees, if the NPV is for these 3 years. But remember, the value of an asset or a project is the present value of all future cash flows. So when I say it is the present value of all the future cash flows, this will be the first 3 years and also cash flows till perpetuity. Now the question says that the net cash flow for the last year remains the same till perpetuity. So there is no growth. 16,637 divided by 0.20 minus G. So this is 16,637 divided by 0.2, and hence 83,185. But remember, this 83,185 is after 3 years. So if I take the present value of that into 0.579, comes to around 48,164. And hence we will say the terminal value is around 48,164 or 165. And the present value of the first 3 years is 59,000 negative. Since the final answer is negative, the project should be rejected. So these are the actual calculations that are actually done over here. Okay, so this kind of takes care of inflation. Now, a few common adjustments to be done in a typical capital budgeting question. First, if there's a sunk cost, what do you mean by sunk cost? These are costs which are already incurred. Should you consider the sunk cost in your calculation? No, it is already done and hence it has to be ignored. Second is, over here sunk cost has to be ignored. Second is apportionment of existing overheads. So remember, if the overheads are directly incurred, which are incremental in nature due to this project, you will consider them. However, if your overheads are, let us say, if your overheads are just pure allocations, so if your overheads are pure allocations, then you will ignore the same because they will be incurred irrespective of you accepting or rejecting this project. And hence, if the question says that overheads allocated to the project, allocated, not overheads directly attributable to the project, then these overheads allocated are to be ignored. So this is allocation and hence they have to again be ignored. The third important adjustment is on working capital. Remember, working capital, when you look at PVCO initially, you will invest, let us say if you are starting a car showroom, you will invest in the premises of the showroom. That is your investment, but at the same time you have to bring in cars. So that is your working capital investment. These cars would be sold, but the money that you receive will be used to buy new cars, which again will be sold. Money will be used to buy further new cars. This will continue till the time the project ends, and hence at the time the project actually ends, usually fixed assets have zero salvage value unless otherwise given. They will wear out, but working capital will be released. So the rule for working capital is, at initial level you will recognize PVCO for investment in working capital, and at the end when the project gets over you will recover, that is PVCI. Sometimes if there is inflation and the question tells you to make an adjustment, then you can always say that working capital investment will have to increase each year. If there is inflation, at the end the inflation adjusted value will be recovered back. This is to be done if the data specifically requires in the question. And then you have a calculation of modified IRR. Remember, how do you calculate IRR? IRR is the rate where PVCO equals PVCI. Now what is modified IRR? Modified IRR tries to improvise on the drawbacks of IRR. IRR says that what I earn from this project is the same that I will earn even from other projects. So the thing over here is, the money that I will receive in year 1, year 2, year 3 from this project, what will I do with the money? I will reinvest it. Regular traditional IRR assumes that the reinvestment will also happen at the same rate at which this project is earning. Now this is a little flawed, because when I look at IRR, this project may give me supernormal returns, does not mean every other project should also give me those supernormal returns, and hence IRR has this problem of reinvestment rate. So what does modified IRR say? They say, okay, you are recovering 100 in the first year, 200 in the second year, 300 in the third year, no problem. This 100 that you are recovering, I don't know at what rate you will invest. However, minimum you will invest in such a way that you earn your cost of capital. So what I will do is that 100 rupees I will compound for the next 2 years at the cost of capital. The next 200 rupees that is received in the second year, I will compound again at the cost of capital for 1 year, and the last 300 rupees is already at the end of the third year, which means I will find the total cash inflow at the end of the third year, assuming reinvestment happens at the cost of capital. Compare it with, let us say, your initial investment, and hence you will try to find an IRR which is called as a modified IRR, which is generally considered to be superior to the traditional IRR, especially in case of projects where this project as compared to the other projects of the company are supposed to give different returns. So this is regarding modified IRR. If it comes, not very important from an exam perspective. And last, we have this concept of adjusted present value. Now sometimes what might happen is, you are evaluating a project, but that project has operating risk. That is, you are, let's say, investing in a toll road project. You have an operating risk of the toll road, and you have some financing risk which is arising due to interest or principal payments. Usually the financial risk and operating risk is different, and as a result you can discount the operating cash flows, which can be sales, expenses, even tax savings on depreciation, everything. You can discount the operating cash flows at the relevant rate for the operating cash flows, whereas financial risk you can discount at a different rate. Now this is only done if the data regarding different rates are given. Otherwise you discount every cash flow using a single uniform rate. However, adjusted NPV says that I will kind of adjust the present value in a way that my cash flows which are financing in nature will be discounted at a different rate, which are operating in nature will also be discounted, let us say, at a different rate. Okay, so this is your adjusted present value. Different components of a project will be discounted separately. Cash flows linked to future demand forecast, different uncertainty as compared to interest and principal, and hence we will use different rates for these cash flows. Now, considering this, there are two other important problems that we will discuss. Now, apart from that, there are three huge problems given in your study material. Now, such a big problems we have also done in our class, but from an exam perspective, you can go through them, those three big case studies. I don't really see that they are very, very important, but probably if you're doing an IBS paper, in an IBS paper where a big case study has to be asked, the institute can also ask you an entire case study. So from an IBS perspective, refer those three case studies properly. From an AFM perspective, just focus on those adjustments for those three case studies. I think in our main book, it is question 4, 5, 6 or something, and that should kind of suffice. Over here, we will see questions which are more exam type. So you will go to question number 2. So let us review this. A multinational company is planning to set up a subsidiary in India where it was earlier exporting in view of the growing demand of the product and competition from other MNCs. The initial project cost considering of plant and machinery is estimated to be 500 million. This is your PVCO. 500 million. The net working capital requirement are estimated to be 50 million. So this is also your cash outflow. I'll have to invest this 50. The company follows SLM of depreciation. Even PP gets depreciated, working capital does not. Presently, the company is exporting 2 million units every year at a price of 80 and the variable cost is 40, which means approximately your contribution or profit margin is 40 per unit and you are exporting 2 million units currently. That is in the past. The CFO has estimated the following operating cost and other data. Variable cost of this project where you are setting up a factory is going to be $20 per unit. Additional cash fixed cost of 30 million and project's share of allocated fixed overhead will be 3 million based on the principle of ability to share. Will I consider 30? Yes. But will I consider this 3? No, these are overheads absorbed and hence they would be incurred even if this project was not there and hence you will not consider it separately. The production capacity in India will be 5 million. We will assume the entire capacity is going to be utilized and hence solve based on 5. The expected useful life of the proposed plant is 5 years with no salvage. So depreciation would be 500 divided by 5, that is 100 per annum. Existing working capital investment for production and sale of 2 million units was 15 million. Now, is this existing investment already there? Yes. So it will not be a separate cash outflow if I were to continue with the existing project. However, if I say that I don't want to continue this existing scheme where I'm exporting goods and I want to set up a new project, then this 15 million will be released and hence can be a cash inflow. Remember, it will be a cash inflow. I will not need this 15 million if I stop exporting. So that will be a cash inflow. However, if I set up a plant, I will need another 50 million. So that will be a cash outflow. So you will have to consider that if I were to set up a new project, I will have to spend 500 on plant, 50 for working capital, but at the same time 1515 will be released and hence probably my cash outflow initially net will be around 535 million if I were to set up a new project. If I were to continue, then it is quite easy. 40 will be your contribution net per unit, no additional investment needed because 15 is already sunk. Export of the product in the coming year will decrease to 1.5 in case the company does not open the subsidiary in India in view of the presence of competing MNCs that in the process of setting up subsidiaries. The applicable tax rate is 35% and the required rate of return for such a project is 12%. So this data is given to us. Assuming there will be no variation in exchange rates of the two currencies and all profits will be repatriated and no withholding tax, estimate the NPV of the proposed project in India. You have been given the 12% factors, 5 values are given. So one option is you continue with the existing project for which you don't have to make any investment and hence 80 minus 20 that is equal to 40 will be the profit. Going forward there will be 1.5 million units. So basically 40 into 1.5 this is going to come to 60. 60 will be the profit in each year. However, profit is subjected to tax. So this is into 1 minus 0.35 and hence 60 into 0.65 will be the after tax. That is $39 will be the cash flow. But this will be the cash flow in 1 year. Remember the project, if I want to compare it with the other, you'll have to have a 5-year life. So over here, if I were to calculate the PVAF, 0.8929, 0.7972, 0.7118, 0.6355 and 0.5674. If I total this, this is going to come to 3.6048. So over here, 39 into 3.60, that is around 140.587. This will be the cash inflow if I were to continue. I can even do differential analysis if I want to. However, if I were to set up this new project, then my cash inflow will be, well, I will sell it still at 80. 80 minus 20, my contribution will be 60. Remember, my selling price is not changing whether I export or whether I manufacture, but my variable cost will fall. So this is 60. And 60 into this time around, I will have a capacity of 5 million units. I will assume this is fully utilized, and hence 300 million will be my total sales or contribution over here. Then additional cash fixed cost will be 30. So minus 30. Okay. Production capacity, expected useful life. I think there will be a depreciation as well, because there is tax. You'll have to consider depreciation. So there will be $100 worth of depreciation as well. And okay, I missed, there was one more thing. If I were to continue, then after 5 years, remember that 15 million investment will now be free, working capital. So over here, sorry to kind of jump the queue, but over here we will say that working capital release. Remember, we already had 15. We did not consider it as a cash outflow because it was already invested. However, this will now be released, and hence this $15 into the last year, 0.5674, which is also a cash inflow. So this is 15 into 0.5674 comes to 8.511. So if I total both of these, 140 and 8.51, 140.587. So this will come to around 149. Institute has also done it, but it is slightly different. They have done the differential analysis. Your ultimate answer will be the same. So this is your cash inflow, 149.08. Now, if I were to continue with this project, there will be depreciation as well, and hence your profit before tax would be what, 300, 270, I think around 170. On this 170, there would be a tax at the rate of 30%. 170 into 30%. Is there any other expense? I don't think so. Into 35%. So this is 59.5. So this is less 170, and that is 110.5. Plus you will add back depreciation 100, and hence your cash inflow comes to 210.5. You don't have any data regarding inflation, and hence you will take 210.5 as the base. That will be your cash inflow in the first year. If I go to see, yes, this is 210.5 for the first, second, third, fourth years. If I multiply this by the PVAF into 3.6048, so this will be 210.5 into 3.6048. This comes to 758.81. So your PVCI would be 758.81. Apart from that, I had invested 50 of working capital, not just 35, 50 of working capital, which will get released. The 15 under the other option is considered separately. So if I were to take release of working capital, 50 into 0.5674. So if I took 50 into 0.5674, this will come to around 28.37. So if I were to total my cash inflows, 28.37 plus 758.81, this comes to around 787.18. This is my PVCI. 535 was my PVCO, and hence my NPV, if I were to set up the new project, my NPV would be 252.18. However, if I don't set up the new project, my NPV will be around 149, and hence the difference, if I go to see, will be around 103.08. What Institute has done over here is, rather than doing this as two separate evaluations, they have done it together, and hence they come to the same answer of 108. So mind you, we have taken continuing, where these two are the cash flows, 140 and 35 and 15 being recovered. If I set up a new project, 535 is the immediate cash outflow, and then 787, that is 210 for 5 years, and then 50 rupees recovered at the end of the 5th year. These are your cash flows. Now this is question number 2. Next you go to question number 3, which is on adjusted present value, adjusted NPV. management of an MNC TL is engaged in the construction of infrastructure project. A proposal to construct a toll road in Nepal is under construction under the consideration of the management. The following information is available. The initial investment will be for purchase of equipment of 250. This is operating cash flow. Economic life of the equipment is 10 years, so maybe the depreciation will be 25 per annum, again operating in nature, will be charged on straight line method. EBITDA to be collected from the toll road is projected to be 33 lakh per annum for a period of 20 years. Okay, EBITDA will be 33, so this is before depreciation for 20 years. Depreciation will be there in the first 10 years, that is 25, will subtract that. In the last 10 years, there will be no depreciation. To encourage investment, the Nepalese government is offering a 15-year term loan. Now, this is a financing cash flow of 150 at an interest rate of 6% per annum. The interest is to be paid annually and the loan will be repaid at the end of the 15th year in one tranche. So 150 into 6% will probably come to $9 to be paid in each year for the next 15 years, and then 150 to be repaid at the end of the 15th year. The required rate of return on the project under an all equity financing, so assuming there was no debt, is 12%. But is there a debt? Yes. Post-tax cost of debt is 5.6 and the corporate tax rate is 30%. Okay. All cash flows will be in USD, ignore inflation. You are required to advise the management on the viability by using APV. The question very clearly tells you APV method, where the given rates are 12% for 10 years. Well, 12% is your required rate of return on an all equity finance project for the first 10 years. Well, first 10 years there is 33 million of EBITDA minus 25 million of depreciation or lakh, whatever it is. Then PVF at the rate of 12% for the total 20 years. Remember, for the next 10 years, there will be 33 lakhs USD, but there is no depreciation. And hence, maybe I will have to do some working at the rate of 12% for the next 10 years. Then you have PVF at the rate of 8% for 15 years. Now, 15 years is the time, this is an annuity factor, 15 years is the time over which interest is going to be paid. So what is this 8%? Probably this must be the rate which is relevant rate for the purpose of discounting debt cash flows. If that was not there, you would have taken 5.6%, which was the cost of debt. But if an 8% rate is given, ICAI has taken that. We will also take that for the purpose of APV calculation. That is why it must be given. And present value factor at the rate of 8% for the 15th year is also given as 3.15. So if I were to look at the operating cash flows, on an operating cash flows, I will say PVCO will come to, let us say, at an operating level 250. Then I look at PVCI. When I look at PVCI from year 1 to year 10, this is 33 minus 25. Okay, 33 minus 25, is there a tax rate? Yes, 30%. So if I go to see 33 minus 25, it comes to what? 8 is a profit minus tax. So over here 8 into 30% comes to less 2.4, and hence 33, this is 8 minus 2.4 comes to 5.6. Now this 5.6 is after depreciation, and hence you will add back depreciation. 5.6 plus 25, and hence this comes to what? 30.6. So probably this is 30.6 into an annuity factor of 5.650. So 30.6 into 5.650 comes to around 172.89. This is for the first 10 years. Now we go to the last 10 years, you have 33 only. There is no depreciation. So 33 is EBITDA minus the tax rate. 33 into 25 into 30% comes to 9.9, and hence this comes to 23.1. 23.1 into, if I take the difference between these two numbers, that will give me the annuity factors for the last 10 years. 7.469 minus 5.650, which is 1.819. So if I do into 1.819, 23.1 into 1.819 comes to around 42.018 or something, or 02, which means 172.89 plus 42.02, that comes to around 214.91, which is your PVCI, but your PVCO is 250 for now. Then you look at the financing leg. When you look at the financing leg, in the financing leg, the PVCI to start with is 150. I've received loan of 150, but then there will be a PVCO, that is $6 of interest. On this interest, there will be a tax saving into 1 minus 0.3 into the PVAF at the rate of 8% for 15 years, because that is given. So 8.559. So if I look at the cash outflow, let us say this is 6 into 0.7 into 8.559 comes to 35.95, and then another 150 that you are repaying at the end of the 15th year, whose factor is given as 0.315. So this is 150 into 0.315, and hence this comes to 47.25. So if I total both of these, 35.95 and 47.25, I will get around 83.2. So if I look at my PVCO is 250 plus 150 to start with, so that is around 100. When you look at my PVCI, another PVCO I think is also this 35 and okay, let us take all of these numbers. So let us say 250 plus 150, then I will have 214 I think plus 214.91. This is your operating cash flows. So I've taken 250, I've taken this total, that's 214, I've taken this 150 as well, and then minus 35.95, which is a cash flow, minus 47.25, which is a cash flow. So this is 250 negative plus 150 positive. You can do alternative presentation as well. So this is 100, 214.91 minus 35.95 minus 47.25. So ideally this will be around 31.71 positive, and hence if the adjusted APV is positive, you will accept the project. So over here, let me just see. I think it is slightly different. Hold on, this is 250. Okay. EBITDA over here, tax saving on depreciation. Okay. For financing, I'm taking 150. Interest is 9. It's not 6, it is 9, and this is I think where we are going wrong. So this is 9 into 0.7 into 8.559. This is around 53. This is exactly the difference, 53.92 I think. So this is, let us say, less another 53.92. And we pray to God that this kind of matches. There is no more calculation mistake. Minus 53.92 minus 47.25 and exactly 13.74. Now Institute has done it differently. They have taken depreciation, tax shield and all of that separately, but in my opinion, if you do a standard table, I've done this in rough. In class, we have done it in a fair format separately. However, what we try to do is we try to find the PVCO, PVCI for each cash flow. Interest separately at 8% rate, principal separately at 8% rate. The cash flow, operating, EBITDA minus depreciation minus tax plus depreciation at the 12% rate. And then you total up everything, you will get 13.74, which is positive. Forget the other alternative solution that the Institute has given. You do this, that is more than sufficient, and that will give you the adjusted APV. Since it is positive, you will accept the project. So this kind of takes care of these questions. I hope these questions have helped you in managing this chapter better. I will see you soon with other chapters. Till then, bye-bye, take care and good luck, study hard.